Good morning, everyone. My name is Steve Moore, Vice President of Food and Agribusiness Capital Markets for the Farm Credit Mid-America. We're a financial services co-op serving 80,000 customers across Indiana, Ohio, Kentucky, and Tennessee. While the world around us has changed because of the crisis we find ourselves in, we remain focused on securing the future of rural communities and agriculture, one home, one farm, and one business at a time. We want to thank you for being here today. In times like this, information, especially the right information, is vital to producers who are navigating the challenges of the COVID-19 has created. At Farm Credit Mid-America, we have the financial strength to work through these challenges alongside our customers. We also have access to experts like those you'll hear from today. We hope today's webinar provides useful information about what's happening in the marketplace and that you'll leave with information that informs decisions you are making. Today, we're bringing you two experts to speak to challenges in the ethanol market. We know that this is a very busy time for each of our presenters, and we thank them for being with us to share their insights and expertise. Before I transition over to our speakers, I want to reiterate that this webinar is intended for the audience on today's call and informational purposes only. It's not for public or media consumption. Of course, any opinions expressed by the presenters are their own and do not necessarily reflect those of Farm Credit Mid-America. Let's get started. First, I'd like to introduce you to Steve Seabrook, Vice President of Commercial Operations for Poet Ethanol Products. Steve has more than 25 years of business expertise in energy and is currently responsible for the relationship management of 36 ethanol plants that produce over 2.5 billion gallons of ethanol annually. He oversees the communication of commercial activities at each biorefinery, including grain and natural gas procurement, ethanol sales performance, as well as market impacts of changing regulations such as RFS, LCFS, import-export tariffs, and ethanol market development activities. Mr. Seabrook is also responsible for the commercial ethanol sales to several key petroleum refiners across the U.S. Steve?
Thank you, Stephen, and good morning to everybody. Let's get started here. So, real quick overview. Clicking the wrong button. Here we go. So, as Stephen said, my name is Steve Seabrook. I'm with Poet Ethanol Products. A little quick rundown of an intro here around Poet, if you're familiar with the company. Our headquarters is based in Sioux Falls, South Dakota. In Sioux Falls, their responsibility is obvious corporate oversight of our company. They are the designers and constructors of all of their ethanol plants. They do all of the research around this industry in terms of starch production and cellulosic production. They have our Poet Nutrition Group is housed out of Sioux Falls, so all the distiller sales happens out of that headquarter office. Our company, Poet Ethanol Products, is based in Wichita, Kansas, so we have roughly 140 people here in Wichita. And as Stephen said, our company handles about 2.5 billion gallons of ethanol production out of 36 facilities. We handle all of the grain procurement for Poet out of this facility, so we effectively buy about 5% of the corn that is grown here in the United States. We procure all of the natural gas for our locations. We capture and market CO2 out of 12 locations, and then we handle denaturant as well. We aggregate and distribute out denaturant. If you don't know what denaturant is, you have to pollute corn ethanol or any ethanol for that matter before you can put it on road. So we take off-spec gasoline and provide that to a lot of the industry before it is logistically moved throughout the United States. So that's just a quick rundown of our company. Our locations, and this is a simple map on slide 9. You can see that we have locations placed all over the country. So Poet has 28 locations that they currently operate and produce ethanol out of. We also have 8 non-Poet companies that we work with as their marketer, as a strategic partner in their business. And if you can see specifically to this group, We have 9 locations out in the Ohio Valley, where many of you listening are located today. So I feel like we have a pretty good presence across the spectrum in terms of the grain areas here in the United States, and have a good idea of obviously what the ethanol markets look like day in and day out. So real quick, I'm going to go through kind of a pre-COVID ethanol outlook that we were talking about at the beginning of 2020. I think it's important the group understands what we were thinking in terms of supply and demand going into this situation. Then we'll obviously get into what's happened with this COVID impact, how we think this is going to look the remainder of the year, and then our continued look forward on how we're going to grow this industry. So just kind of kicking this thing off, you know, a year ago, and I'm going to wind the clock back to just about a year ago now, the industry was faced with a lot of changes. As you guys all know, as a farming group, we saw significant spring flooding that was wreaking havoc on local grain basis in different parts of the country. And specific to your area, you guys know what was happening in the Ohio Valley, as well as South Dakota and Northwest Iowa were probably the most severely impacted areas when it comes to this change. We also saw a year ago, May, June timeframe, that's a seasonal reduction in ethanol exports, happens every year. It's just what it is. And then at the same time, we saw production in our industry peaking out at about 16.5 billion gallons, which was too much, and I'll get into that in just a second. The result is that our industry saw tremendous margin changes in a negative way, and we had to make a change and decrease ethanol production to the tune of over 2 billion gallons of production. And this chart indicates that. We're on slide 12 now, and I'm going to use my cursor here while we're talking. So back in this May, June of 19 timeframe is where we saw the rains hit and basis in ethanol in corn started to dramatically impact our capability to produce at any type of a margin. And the result of that was a tremendous shutdown in production. And you can see where I pointed the low point here around that September, October timeframe. From a margin standpoint, once we removed all of this excess production, well, as you guys know in the commodity business, we saw those margins dramatically increase in the fall of 2019. So, and again, in the commodity business, what does our industry do? We ramped right back up from a production standpoint, and we're sitting at similar levels that we were at in the spring of 19. So as we started 2020, click one more, the supply and demand outlook was pretty tough for our industry. And this is a rundown that we were showing all of our plants at the beginning of the year. And what it's telling you is from an S&D standpoint, our industry had the capability to produce effectively 16.5 to 16.6 billion gallons of ethanol. We also were going to see roughly 150 million gallons of ethanol imports coming into the United States. That might be a surprise to the folks on this webinar, but for the last couple of years, because you have a low carbon fuel standard in California, where there are credit values that you are allowed to receive, even Brazilian producers are allowed to receive that credit, it has synthetically made some importers competitive into the United States. So as an example, in 2019, we saw about 250 to 300 million gallons of imports coming into the United States, due in large part to these credits that sit out there in the marketplace. We trimmed that expectation down in 2020 to about 150 million gallons. That's what you see here. Then you look at our demand base, and this is just simply taking gasoline demand at 10% of what we had forecasted going into this year. Roughly 14.5 billion gallons would be the domestic demand. And then our international demand of exports, that's what this is, we have pegged at about 1.6 billion gallons. That assumed no growth in China. This was all pre-phase one trade deal talk. So the punchline to this is, going into 2020, our recommendation to all of our plants was we were going to be sitting somewhere in that 500 to 700 million gallons of oversupply as an industry. That's a 4 to 5% oversupply rate. And as you guys know, in the commodity world, that is a massive number. So we knew going into this year it was going to be very challenging to start. And then came COVID. And so you go into February, we start to hear stories out of China, how big of an impact this disease is going to be. We roll into March, the stay-at-home situation begins to ramp up in a big way. And by the first week of April, in an unbelievably short span of time, we saw gasoline demand drop to levels that we haven't seen in 50 years. Now, I specifically bring up gasoline demand because, like it or not, our industry in the ethanol world is tied to gasoline demand in a big way. So what I'm just showing you here is dating back to 1960. This is annualized gasoline demand in the United States. And I am taking the 1 week number that is given every Wednesday. The DOE puts out statistics around petroleum, ethanol use, things like that. This is showing you on week ending April 3rd what we look like in gasoline demand here in the United States. So again, we saw the equivalent of 1966 gasoline demand levels, a fallback of 50 years. So what does all of this mean to you? So, and I apologize, I'm going to be shifting back from barrels and gallons and things like that, but my punchline I wanted to get across to you guys is the impact to the grain markets. So all I did was take real simple math using averages of gasoline demand. Pre-COVID, 142.5 billion gallons of demand in a big round annualized number. Through that April 3rd date that I showed you on the last slide, we're down to about 77 billion gallons of demand. That's 54% of normal. And you can see what I'm doing is just simply taking ethanol at a 10% inclusion rate in gasoline. I'm not including exports. I'm just trying to give you a simple breakdown that we had a demand destruction of roughly 6.6 billion gallons in gasoline demand alone. Using a 2.85 gallon per bushel yield, that is a destruction of corn demand, underlying corn demand of 2.3 billion bushels. So as Stephen and I were talking about this webinar, he had asked that we talk a little bit about the volatility and basis that you guys are experiencing. That is point number one. That is a dramatic change to the consumption of grain here in the United States. And you saw that in corn price and basis change over the last 5 or 6 weeks. And Shelby will talk about that later. So I'm going to stick to gasoline demand. So you quickly fast forward 5 weeks later. This is the latest Gov report. We have another one coming out tomorrow. Now that stay-at-home is being lifted, we are seeing, it's good news, we're seeing gasoline demand return. As of last week, we've recovered to about 78% of normal. That's where you see this blue line pointing to where we are. That's great news. The bad news is that's gasoline demand that's similar to 1990. So while we've seen an improvement, we're very happy about that. We're only getting started on where we need this thing to go. So to keep this in the same context as the previous 2 slides, what I did was, again, using the same starting point of 142 billion gallons of gasoline demand, we've now recovered to 78% of normal. That's this 113 billion gallon level you see here. That still is almost 3 billion gallons of demand destruction that we're sitting on despite this tremendous recovery thus far. That is the equivalent of 1 billion bushels of corn consumption that doesn't exist if we remain at these levels. So again, good news, we've moved from 2.3 billion bushels of corn destruction demand to 1 billion bushels of corn destruction demand. The bad news is we still have 1 billion bushels of corn destruction demand that's sitting out there in the marketplace. And that's a concern for everybody involved, as you can imagine. Moving along kind of quickly, I'm on slide 19 now. One of the questions was asked was, well, what do ethanol stocks look like? I apologize, this isn't the greatest slide. I'm not going to really focus on the blue line, which is production. And you can see the production, how it dipped off and where we're sitting today. I want to focus on this red area. That is ethanol stocks. So to give you a little context here of what you're looking at, historically, when the ethanol industry is sitting on what I will call a stocks to use ratio, it's a similar measurement. If we're sitting on 22 to 24 days of stocks in the ethanol world, we're not really making any money. Our margins typically are very depressed at that type of level. So to give you an idea of just how much these stocks jump when you see the 27 million barrel stock level up here, that's the equivalent of over 50 days of ethanol supply at that level. Here's where we sit in the last report. So we've seen stocks in ethanol coming down quickly. That's good news. The bad news is we're still sitting on about the equivalent of 39 days of ethanol stocks today. So I wanted to frame that up to give you an idea of the amount of ethanol stocks that we have to chew through in all of this. So what has the industry done? What the industry has done is ratcheted back production in a very, very quick way. So pre-COVID, we were sitting on about 16 billion gallons of ethanol production. The low point that we got to on that April 3rd date is about 8.2 billion gallons of ethanol production. That's the equivalent of 2.7 billion bushels of corn destruction in demand. Our last Gov report on 5/8, sticking with those same numbers, we're at a level of the equivalent of around 9.5 billion gallons of ethanol production. So one of the questions I got this morning from Stephen right out of the gate was, how does it feel? Are ethanol producers returning to normal? And so I put this comment here about market feel. If I had to gauge it right now, I would say that ethanol producers are cautiously moving back into the market and increasing production to meet demand. And let me underline that statement. We are increasing production to meet demand. So to say that the ethanol industry is going to come racing back to the levels that we saw pre-COVID, I don't think that's what we're going to see. I could be wrong. I don't think that's what we're going to see. I think you're going to see a pretty disciplined group of guys out there simply trying to meet the demand of the petroleum refiners as they're bringing their gallons and their demand is coming back online. And here's why that's the case. If you look at slide 21, this is just a very generic margin chart in the ethanol industry that we've kept dating back 20 years. But I'm going to point a few things out here. I know this is a busy slide. I'm going to show you that where our margins went, this is a level of margin back in March and April that we've never seen as an industry. And I think that a lot of people can say that. Crude oil guys can say that. Gasoline guys can say the same. And so you can see that we've seen a pretty dramatic recovery to basically break even EBITDA. That's where we're at, guys. And you can see what that looks like versus 2019, 2018, and 2017. But I included 2012 in this graph. And the reason I did that is because 2012 is kind of the bellmark bad year for this industry. That's when we had significant drought across the United States. Margins were terrible across the board, and we saw a dramatic decrease of almost 25-30% of production in our industry. So when I say that we're recovering and I say that ethanol producers are going to have to be disciplined and careful about how they operate, we're just back to those levels. So we're not having any fun at this yet, to say the least. And again, that's why I make the statement. I think folks are going to be very cautious in their return and only meet that of what demand that they're seeing coming at them. That's my guess. So the big question going forward is okay, now we've started this recovery period. What next? Now that we have people returning to normal, are we going to be at 75% of normal? Are we going to be at 80% or maybe 90% of normal? It is really, really difficult to know that answer. I think most are expecting an 80 to 90% return, which is great, but you still have to remember in that you have a 10 to 15% reduction while you're saying that. So at this point, we're just going to have to wait and see. Anybody that tells you they know for sure, I would question that. We're planning for the worst and we're hoping for the best as we go forward here. In the meantime, I'm going to close with this. Our sole focus is to continue to move forward with E15, regardless of all of this stuff that is going on. And that may sound funny, but as we see this recovery, we have customers that did make the shift to E15 prior to this COVID situation. And while this COVID situation has been going on, they have continued to see good success in selling E15 at the pump. And this map is simply showing you from a petroleum terminal standpoint where E15 is available today. Our industry was making tremendous strides getting this out there and available for the market to consume. And then this hit, yet we continue to see E15 sales out there today. The single biggest point that I like to make when I'm talking to a farmer group is as we continue to move this E15 ball forward, when we talk about the capability of a consumer to be able to use E15 in their cars. This chart is showing you, if you don't know this, going back to 2001, the EPA has approved 15% ethanol blends in any vehicle 2001 or newer. This chart is simply showing you the number of miles driven in automobiles with a 2001 or newer car. We are now at a 97.7% level of miles driven in the United States in E15 capable cars. So our question remains, why aren't we rolling this out in style? We're using a product in E10 that is addressing effectively 2.3% of the miles driven on road. We need to get more of this stuff out in the marketplace. And when you ask the question, is it competitive with gasoline? I put this together back on May 8th when I was putting this presentation together for this seminar to just illustrate this point. Worst crude oil environment, worst gasoline environment we've ever seen in terms of ethanol competing with gasoline. And yet, if you look at the price of gasoline in Chicago back on May 8th, 84.7 cents a gallon, that's a wholesale price. You look at a cost of E10 example, we're a penny below that. And if you look at a cost of E15 example, we're a penny and a half below that number. So at a period that we have seen the worst petroleum economics from a competitive standpoint we've ever seen, our products are still more competitive than theirs in this environment. So we're going to keep pushing this. We're going to see recovery happen. I think by the middle of next year, we're back on the road to full recovery, but we're going to continue to push this. And what it means to the farmers, I always end my presentations with this point. A 7 billion gallon change of ethanol demand is what you're looking at if we can shift to E15. That is 2.4 billion bushels of corn consumption that goes along with that. So yes, we're going to continue to push this. We're going to continue to try and grow our product, and it's fantastic for the ag sector in the process. So that's the message I was going to leave you with. I sincerely appreciate you, the folks inviting me to speak to you guys. So I thank you for having me. And with that, I'm going to turn this over to Stephen to introduce our next speaker. And thank you again for having me.
Thanks, Steve. I'd now like to introduce you to Shelby Simmons, Senior Ethanol Marketing Manager for the Andersons, Inc., headquartered in Maumee, Ohio. Shelby's core responsibilities include overseeing the sale, logistics, risk management, and customer relationships for the ethanol and distillers corn oil produced at the Andersons' 5 U.S. facilities. Shelby?
Okay. Great. Well, thank you, Steve, for the quick ethanol market outlook, and thank you, Stephen, for the introduction. Now we're going to dive deeper into what our outlook looks like for corn and how that ties back to ethanol, and really what that value means to the end user and the producer. And the biggest thing we're looking at now, as Steve talked about, was the reduction in gas demand, and that's a really big barometer in what's ahead for us. The reduction in gas demand obviously affects the ethanol production. And the question, I think, is the big question is really, are ethanol producers going to fire back up? And if they do, at what rate are they going to produce? Is that 80% of their capacity, 90%, 70%, potentially 100%? All that's going to play into a big effect in terms of corn values when we talk about ethanol plants, and really corn futures for that matter as well. We've talked a lot about EIA stats and stocks, and for the last 5 weeks, you know, we've continued to have record stocks and record stocks and record stocks. And really, we need to see a draw in those stocks to understand what could happen in the ethanol industry, plants firing back up. All those things need to be balanced out in order for plants to make sense to come back up and keep grinding corn. So first, I want to introduce who the Andersons are and really where we are as well. So we were founded in 1947. We have facilities throughout U.S., Canada, and England. And we're comprised of 4 main groups. They consist of our trade group, our ethanol group, our plant nutrient group, and our rail group. And as you can see from this map, we're strategically placed in locations dependent on the business groups. Between our groups, we produce roughly 550 million gallons of ethanol, trade 1.3 billion bushels of grain, and move around 2 million tons of P&M products to farmers such as yourself while managing 25,000 rail cars. We really take pride in connecting the farmer throughout the whole value chain. Specifically, the ethanol group, we have 5 plants, one in Clymers, Indiana, one in Greenville, Ohio, one in Albion, Michigan, one in Denison, Iowa, and one in Coolidge, Kansas. Also, our headquarters again are in Maumee, Ohio, and we have an office in Kansas City. Out in Kansas City, we have quite a few traders. We have some ethanol folks out there as well, but the majority of our ethanol team really sits in Maumee, Ohio. One plant we're particularly proud of is our Coolidge, Kansas plant, which is the Element plant. This plant has, quite frankly, the most advanced technology you can put in an ethanol plant today. And those gallons have a very, very low carbon intensity score. Steve had chatted a little bit about LCFS and what that means. And essentially, these gallons have that low CI score, so they spread well to California, and they're a premium in the market due to that. This is really a factor that many plants are looking at throughout our industry and figuring out ways to get a low CI score to take advantage in these opportunities. Real quick here, just wanted to talk a little bit about the Dow Jones Industrial Average chart here, really financial market, and what the COVID-19 pandemic has really caused. As you can see, back when COVID-19 became quite the issue in the U.S. and throughout the world, we saw quite a downturn in our value of the financial markets. And really that spread into the grain markets as well. It appears a couple of weeks ago we bottomed out, but again, there's still a lot of what ifs and concerns in terms of what's to come with COVID-19. Many of the states are back open in terms of their economy, which has been positive for driving demand. But overall, this chart really shows how much the COVID-19 pandemic has impacted us. And really what we're focusing on from the ethanol side here is as the economies come back open in the states, what is that going to do for driving demand? We need to see that demand really pick back up in order for ethanol production to be continually brought online. One thing we really look at in the industry of many is the ethanol crush, and I wanted to dive into this and just kind of explain what ethanol crush is and how it impacts the plants, and quite frankly how it's used in the industry. So ethanol, a simple calculation, is ethanol plus corn futures divided by 2.85, and this will give you a cents per gallon. So what this looks at is it says here's the current ethanol price plus the corn futures price, divide that by 2.85, and it'll give you a calculation. And you can do this for deferred months, you can do this for any months, but really you want to tie them month to month. So ethanol minus corn futures divided by 2.85, back when the pandemic really began, we were looking at -30 to -35 cent crush. As you can see, this chart has climbed, and we're back up in the positives, call it plus 2 cents today for crush. And what does that mean? So typically -10 to call it maybe -12 cents crush. You have issues where it's not exactly the best situation for the ethanol industry, and it could indicate that stocks are building and we're filling up terminals in every nook and cranny in the industry. But again, as you can see, these values have gotten better. So to be back in positive crush territory, that's a positive sign. One thing to note on this is this does not take into account corn basis. This does not take into account sales of your DDGs, your corn oil, value that you can sell ethanol above or below the ethanol price. So those are all things we look at. But again, this is a really big barometer when we look at the industry and understand what everyone can see day to day in terms of values. Next, we have a December 2020 chart. We can all admit this isn't a pretty chart. Back roughly a year ago, we were well above $4, and now we're knocking on the door of $3.30. And quite frankly, I think we could see $3 corn futures. There's been a lot of demand destruction that has caused values to obviously plummet here. There's projected corn acres are record. I think we'll talk a little bit about that here in a minute. But again, all these are working against us. So the question is, where does corn go today? With the way the weather patterns look and planting progress, we're well above on that curve. And farmers have been extremely proactive in putting the crop in the ground and have had those opportunities. I think $3 corn futures is quite possible. So with that being said, I think there's opportunity now from a corn future standpoint to take advantage of that. But if we see all these things really kind of play out, again, I think $3 could be reality. The next chart is December 2021 chart. And really all I wanted to show here was simply there's a carry in the market. So December 2020 is worth less today than December 2021, as it should be, right? Where we have what could be record carryout stocks, and here going into 2020, 2021, over 2 billion of stocks rolling forward. So all things that would indicate is you have stocks in the marketplace, value should carry into it. So this is really a way for me to explain to you that the longer you hold on to your grain, the better it is. The one thing that we need to be cognizant of is if you pick up, call it 25 cents and carry from December 20 to March of 2021, that's great. But if you lose that on the basis end, so let's say basis is worth 25 cents less in in March of 2021, it's really net even. So those are things, when you look at carries in the market, look at what basis is doing, understand how that affects that, and really have those decisions made so you can figure out what to do with your own crop. This here is just a quick look at what corn planting progress looks like. We're well above average. Two states that really stick out to me are Iowa and Illinois. Those are big corn growing states. So that's a big focus for us. Things look really, really good here in Northwest Ohio. I know I'm saying this after we've had over 4 inches of rain from the local drought territory here in Northwest Ohio, and we've also had large rainfalls throughout the U.S. But again, things look good. I think we'll continue down that path. If we get some sunshine, we'll get the rest of this crop in the ground, and things will feel pretty well from that standpoint. So here's the May 2020 WASDE. This was released right about a week ago. We're estimated to plant 97 million acres with roughly 90 million acres of harvested, and gives us an ending stocks of 3.3 billion. That number is absolutely huge. But the question is, what if we didn't get, call it 2 million of that harvested? Well, quite frankly, based on May's WASDE, that would still put us at a 3 billion carry out for 2000 to 2021 crop year. And again, that would be an indication, in my opinion, that corn futures and corn basis, for that matter, would be lower. There's still some things in here, that are kind of curveballs. You could look at the exports. We've been talking about China and what that means, and that conversation continues. Same for ethanol. How quick will ethanol production come online? Are there plants that, due to COVID-19 and just gas demand destruction, resulting in ethanol demand destruction, does that play into it, meaning less corn grinded? I mean, all things we can keep an eye on, but when you look at today's sheet, this shows that carry out of 3.3 billion. So one thing that I would like to challenge really anyone on this call is to understand that we're looking at a different crop year when we look forward for this coming harvest. And quite frankly, it's a lot different than previous years. So a quote I threw on here, and I'll go ahead and read it, is when the facts change, I change my mind, sir, what do you do? And this is from John Maynard Keynes. And that's a great question. What will you do when the facts change? If we put the record crop in the ground, we have the good weather, we have everything really set up nicely for us, I think we're going to have a huge ending stocks. And the question is, what can you do from your farm? Maximize the grain bin storage that you have. Have the relationship with your merchandiser and understand how to market your grain here on the front end. But again, as it looks today, we're looking at a very, very large crop. This here is a quick soil moisture chart. As you can see, things look really well again for us. There's really no concern when you look at the corn growing areas in the U.S. This is a chart that I would challenge any farmer or anybody for that matter to just kind of look at weekly or every other weekly to see how things are progressing and what the changes are. It's droughtmonitor.unl.edu. But again, overall things look really, really well for us from a soil moisture standpoint. This last chart is really just summer weather outlook, and so these show what does the temperatures look like and also precipitation. Now, overall, again, things look great here. Potentially, this is a 3-month outlook. Potentially we could get a little warmer. It looks like we got some moisture moving in too. If all these things play out, we can have a really, really good crop. If we get dry, if we get too wet, will we get to 178.5 that the Maywazi is predicting? I think it's still very, very likely. We would have to have some serious issues, in my opinion, based on how well the crops went in the ground so far. So key takeaways. One thing I wanted to just touch base on here is corn basis. So what can we sell our grain for above or below corn futures? Be proactive in these decisions. I think today corn basis levels look like a fair value given the current markets. When we look at ethanol production and how that could potentially come online right now, the ethanol facilities in particular, are working through their inventories. They've carried grain through a carry. But as we run out of that corn, corn basis could firm up depending on how corn moves. But again, the big question goes back to how much ethanol production will fire back up. And again, are they going to fire back up at that 80, 90, or 100%? But overall, again, I would say just be proactive in those decisions. I don't see corn basis screaming real high here in the nearby, but we could see a little pop just to get some guys through to new crop. But I would say, work with your merchandiser and see what opportunities are out there for you. With that being said, what does a working relationship mean with your merchandiser? It's not just a one-off conversation talking about corn bids today and what are your thoughts for tomorrow. It's really a two-way relationship. Talk to your merchandiser, ask them for their opinion. How can we leverage these positions and build a personal relationship with them? At the end of the day, the merchandiser really helps you make decisions as to how profitable you can be and how you succeed through these trying times. It's extremely helpful to have that merchandiser on your side just to help you operate your farm day to day and understand the impacts when you're moving your grain. Another key takeaway: what is your break-even value at your farm? Simply, what does it take to run your farm? Run that calc and try to understand those values. Understand what prices you need to sell in order to break even, and understand what would happen if you sold below those break-even values. At the other end of it, understand if you sold above the break-even values, what does that mean to your bottom line? All really important numbers when we talk about this. What risk tools can you use to market your grain? We see a lot of traditional contracts, if you will, in the marketplace. Basis contracts, flat price contracts, spot contracts, and those simply are all tied in futures and basis. But there's really a lot of risk tools out there. Different companies have different names for these risk tools. And quite frankly, a lot of these are simply options. I try not to talk about options as they can be confusing when you talk about puts and calls. But simply, again, this is just a value that you feel comfortable selling, and what ranges of prices are you happy with selling. So for example, let's say we get to CZ20 and you could sell roughly $3 or $3.10, and maybe you feel really comfortable selling $3.90. There's a range within that you feel comfortable with. Talk to your merchandiser about these opportunities. What values make sense for your farm? How can we accomplish that? Now, again, options, these are simply options, and there might be a cost involved with that. But if that cost is minimal and you understand those costs and understand how that works into your farm, it could be an opportunity for you. What will I do this year that I haven't done before? Think on that. As I gave a quote earlier when we were talking about the Maywazi, I think things could change in a hurry, and quite frankly, they might not change it for the betterment of the farmer in terms of corn basis values and even corn futures. So just think about what can I do. Quite frankly, I'm bearish corn futures. I'm neutral, slightly bullish nearby corn basis, and deferred slots. I'm bearish corn futures and corn basis. So be proactive in those decisions. And lastly, make safety a priority. The ethanol industry and the ag industry, we encourage the farmer every day to do this and come home safely to their family and friends. This should be our number one focus at all times. I'd like to thank Farm Credit and thank Steve for his presentation. Really appreciate the time I was able to spend with you guys today. You guys have a safe planting season finishing out and have a happy harvest as well. Thank you.